Last quarter posed challenges for the banking sector as geopolitical tensions, roaring inflation, impending economic slowdown, and intensified fears for a potential recession are still ever present. Furthermore, the aggressive monetary policy tightening by the US Federal Reserve raises concerns as the chances increase significantly for tripping the economy into recession. In this report, we focus solely on the earnings seasons of the financial sector, analyzing the results of the banking behemoths JP Morgan, Morgan Stanley, Citigroup, and Goldman Sachs. The common themes that stood out were the industry-wide weakness in the investment banking segments, the pause of share buybacks across the board, and the increase of reserves in an attempt to salvage potential losses, as global economic outlook worsens. We conclude with a technical analysis of Citigroup, sharing our views for the future development of its short-term horizon. JP Morgan shares dropped more than 4% on the 14th of July after the Q2 earnings releases, missing both earnings per share and revenue forecasts. The company's CEO, Jamie Dimon, struck a cautious note on the global economy as he believes a storm of uncertain magnitude is coming, kicking off the earnings season with a grim outlook. The fears for investment banking taking a hit this quarter were validated, as the bank reported more than 50% drop in fees across all products and took loan markdowns on some of its investment banking business. The reason for the slump were none other than the harsh market conditions, including the ongoing conflict in Ukraine, which made companies hesitant in engaging in new deals, raising equity and debt. However, net interest income rose alongside with fixed income and equity trading, making the most out of the market volatility. Morgan Stanley also saw its shares drop on the 14th of July and reported massive reductions in deal makings as the economic uncertainties does allow for such. This comes as a U-turn compared to last year's performance, whereas the company was riding the deal-making wave and advised some of the biggest companies and underwrote some of the largest names the float market. The trading segment was the bright spot, alongside the revenue gain from net interest income. Citigroup shares surged more than 10% on the 15th of July after the Q2 earnings releases, beating both earnings per share and revenue forecasts. The main drivers for the outperformance were its treasury and trade solution segments, while the slacker was the investment banking division. The treasury's revenue came from an increase of interest rate income as a result from higher rates. Increase in the trade solutions segment's revenue came from capitalizing on the volatility in commodities and foreign exchange markets. The slump in investment banking revenues came from shrinking of the underwriting and advisory fees. Even though the losses from investment banking were substantial, they were insulated by the treasury and trade solutions powerhouses' exceptional results. Despite strong positive results, however, Citi will suspend share buybacks to increase the key regulatory capital ratio imposed by the Fed, acting as a cushion accounting for the possibility of a recession. Nonetheless, CEO Fraser's planned restructuring appears to gain traction and heads toward the right direction, showcased by the strength of Citi's core operating business. Goldman Sachs shares rose on the 18th of July after the Q2 earnings releases, beating both earnings per share and revenue forecasts. Even though the company reported profit reductions approximating 50% compared to Q2 for 2021, the outperformance was due to the incredible gains in fixed income and commodities trading. The slump was partly due to the interest rate hikes from the Fed, attempting to ease inflationary pressures, which scared away companies making the wary of stock and debt offerings, a common theme this quarter. Goldman Sachs showed resilience once again, providing that it can excel in challenging environments compared to the majority of its competitors. On another note, the bank's CEO David Solomon announced that hiring velocity will be slowing this year and will also reduce certain professional fees.